Hi, Kieren. Thanks for joining me on the podcast today.
Thanks, Andy. Thanks for having me. Good to be here.
I've seen you knocking around the community for a long time now, doing a lot of projects and some really, really great looking stuff. So I'm looking forward to this conversation. And I think particularly because what you do and the sort of spectrum of your service in the HMO world, I think is quite extensive. And I think we can have a really good conversation about that whole process. So for any of our listeners today that are maybe getting in for the first time or are just gathering their experience, I maybe don't have confidence at different parts of the process, might be buying, might be the refurbishments, might be the refinancing. I think there's a lot of stuff that we can discuss today that I'm looking forward to. But before we get there, Kieren, for the benefit of perhaps our listeners, can you tell us a little bit more about yourself, what you're currently doing in property and how you ended up in property, and particularly in HMOs?
Yeah, definitely. Yeah, firstly, thanks for having me. As I say, great to be here, Andy. My background, albeit not, hugely extensive in terms of sort of commercial 25 years of operating. I can't say I have that, obviously due to my age, I'm 25. But yeah, we got started in property sort of 3.5 to 4 years ago, came out of university, studied physical geography, so nothing overly academic. That route didn't take me into sort of a professional role post-university. Wasn't quite sure where I wanted to go, so moved into estate agency space. Knew it was somewhere within property, just didn't quite have an initial sense of direction other than that I wanted to get started in some capacity and sort of get my feet on the ground with some professional experience. So worked for quite a high-end estate agency in an area of Hertfordshire, starting in lettings, progressed in, a couple of years that I was there into sort of sales, and then I moved on to a self-employed sales role. Fantastic in terms of building a foundation and, getting an experience in that sort of professional world within property while I worked out what I really wanted to do sort of long-term. As many people do, sort of started to look at wider resources, YouTube, books, people who were already sort of making movements in the property space, came across rent to rent as a business model. I didn't have surplus cash funds behind me, so I knew that I needed to essentially look at building a cash flow based business in order to try and build up my own funds to invest in, my own projects and assets and whatnot. So that's sort of how I got started on my journey. Acquired a few rent to rent properties around a few areas of London that were closer to home. And that's where I sort of, again, got my feet on the ground in the HMO space and sort of started me on the trajectory to where I am now, which is obviously specialising in large HMO conversions, predominantly in Article 4 areas in the south of England. Yeah.
So where did the interest in property actually come from, Kieren? Or was it more the interest in building a business, getting, control of your time, maybe building an empire? Where did that actually come from? Because geography to real estate is potentially quite a big leap.
Yeah, it's a fair comment. I think the sort of early initial sort of, reaches into property, my interest in it came from twofold, both from family sort of motions. I had family who were based in construction and, worked on construction sites as a labourer in my school holidays as a bit of spare cash. And then other family members have had, sort of 2 or 3 investment properties, nothing crazy, just stand sort of buy to lets. And that's probably the main reasons for it, at least opening my eyes to, what is possible within property and sort of set me on my way with, trying to create something for myself in that space.
When you were planning that transition, when you were starting to make those movements into the property space, I imagine you were probably talking to your mates about this sort of thing and other people. What sort of reaction did you get? Because this is something that I remember, and I'm interested to hear your experience of this first. Then maybe I'll share mine, but How was that for you? Did you know people that were already doing this? Were you, did you feel like a bit of a lone wolf? Did you feel like a bit of an outcast? Yeah, what was people's reactions when they started to find out that this is what you wanted to do?
Yeah, it's a good talking point. It's very relevant in the sense that one of the people who actually were quite foundational in putting me on to, other people who were doing well in the space was a university friend. He actually gave me a copy of a Samuel Leeds book, Buy Low, Rent High. And that sort of got me on the wave of researching people and what strategies were possible. But at the same time, yes, all of my sort of graduate friends were looking at corporate roles, graduate roles, moving, into the city for sort of corporate based, career growth. Whereas I sort of took the opposite approach to that and definitely didn't want to go into the corporate space. I knew that. And yeah, you talked about sort of being a bit of an outcast. I've generally always fitted in what I've done, played sport and been fairly sociable. But it is an interesting transition when everything you've ever known and everybody that you've ever known goes one way and you go the other. there is a bit of working out to do, let's say. Yeah.
It can be a bit daunting. I remember when my interest is similar to you. I used to do a bit of labouring. I used to actually love labouring. And I secretly, sometimes wish I could just not do any of the business stuff and just pick up, and brush around the site. But I used to do some work for my uncle. And I think that that's where my sort of interest in building came from. But when you leave university, not only do you often not have any money, you actually is carrying debt from university. And it was the same for me. And a lot of my pals did the same. I went into a professional career, but didn't particularly enjoy it. And I remember really trying to heavily lean into the property stuff, trying to just figure out how I could do it. And perhaps even at points it became a bit of an obsession, just trying to figure out how to break through. How could I actually generate the cash flow? How could I create the capital? And it was really hard. And I remember, a lot of my friends taking the piss. And I think that, I can take anything on the chin and can certainly, have a laugh at myself. But I think when I found out some of them were taking a piss when I wasn't there, I found that pretty hard, actually. And I think that continued for a number of years. And for years, it was a lot of work for very little progress. And I think that one of the things that I learned through that process is actually that is what it takes. And obviously now, however many years on, 10, 15 years on, I don't think that many people are laughing now. But I remember that was a bit of a challenge for me. And I had to find a lot of people. I had to find a whole new network just to find that support and motivation and encouragement and just to bounce ideas off. And it was so different to anything that I had experienced before. But I just remember how tough it was. And I think it's interesting talking to people about this because there are so many people, and there'll be a lot of people listening today that perhaps make assumptions that it was really easy, or that kind of there was some sort of gifting, or all your pals are doing it, so that it was just natural. But it's interesting to hear again that your story and your entry into property was also very different. So
yeah, I think it's a really good point for, you mentioned obviously the listeners out there to try and sort of get an understanding of it and how they might compare it to their own journey and their own growth. But no doubt, I'm pretty sure that you are, big advocate for putting yourself out there in terms of brand and social media. It was particularly when I first started to put my face out there and use various platforms to promote, my rent-to-rent services at the time, which is what I was doing.
It helps if you're good looking as well, Kieren. I'll give you that.
I wouldn't know. But yeah, that was where a lot of my initial early stage pushback came from. When I started to put yourself out there and people are like, what's this guy doing? What's he trying to do? Yeah, now obviously it's a slightly different story because, backed it up with what I've been able to deliver. But yeah, it's a very relevant point.
Absolutely. I think it's also interesting that you looked at rent to rent as that option, that opportunity, that almost gateway to get you where you really wanted to. And I didn't know about rent to rent. I'm a little bit older than you. I didn't know about rent to rent when I was just getting started, but found it afterwards when I was experiencing the same issues of not having enough capital. How do I generate the cash flow? Actually, for me, a big part of it was also, how can I generate the experience and immerse myself in this industry, build contacts and networks and figure all of this stuff out. And I think rent to rent is still a great way to do that, but it absolutely does have its limitations. I mean, you've gone on to do a lot more, and a big part of your business has been the whole turnkey service. So tell me a little bit more about that. So you, and a lot of the work that you've done, Kieren, correct me if I'm wrong, but has been on the South Coast.
Yeah, absolutely. So predominantly done probably 75% of the work that I've done has been in Portsmouth today. Done work in Southampton, done work in Hull and Bournemouth, and some new areas as well, which I won't touch on for the time being. I'll speak about the areas that, successfully delivered projects in. But yeah, those being South Coast areas, Article 4 predominantly as well. Hull is excluded from that, but the other areas that I've mentioned are Article 4 and impacted by the restrictions of Article 4.
Yeah. Well, this is something I want to talk to you about because I think for a lot of people that poses a huge challenge. And of course, there are challenges to Article 4. And I've shared my own opinions and experiences of Article 4. I still invested in areas where there's an Article 4 direction and have done for many years. But some people often struggle to just get lift off. And Article 4 is often the reason, I hear why. But, it's obviously not stopped you. So just tell us a little bit about the planning restrictions. And that can be, I suppose, even more specific to a particular area and how you have managed to navigate that and even use it to your advantage to build the business that you have, Kieren.
Yeah, I guess from a starting point, I've only ever known Article 4. It wasn't like invest or work outside of Article 4 and then make the transition, to work within it once you've got comfortable and found your feet. when I originally started, I had a mentor for the first 12 months while I was investing in rent to rent as a strategy, but also investing in myself to understand, HMO conversions as a turnkey business model. And that was on the basis of an Article 4 area, which was Portsmouth. But in terms of, for me, why, I'm a big advocate of Article 4, various reasons. You've got your own, everybody will have their own. For me, main principal reason is Article 4 has been brought in for an obvious reason, and that is to control and restrict the volume of houses that are being converted within an area, to a HMO. Now, that volume and demand wouldn't be being converted if there wasn't a demand there from a tenant's perspective to serve that need. So it tells you all you need to know in terms of there being a demand for the product that you're wanting to create. Now, obviously, that Article 4 introduction will also put a lot of people off who, either aren't educated in it or don't have the time to educate, or, for whatever reason that it does put them off. That obviously narrows down the market of people who are prepared to do it. And therefore, you've got a better chance of creating a standout product and in turn, hopefully grow and scale a great portfolio off the back of it. Other elements in terms of, commercial lending come into it. If you're converting large HMOs, particularly within Article 4 areas, yes, there's other exterior elements as well, but a big element and tick box for commercial lending as opposed to a bricks and mortar valuation and lending arrangement, obviously is, having Article 4 in place helps with that.
I think, and I agree with everything that you just said. I think if you were going to set up an ice cream shop, the place to do that is obviously by the seaside. And, you've got that foot traffic, you've got that footfall. And Article 4 direction is almost, it's like the council literally saying, look, we're going to let you do that and we're going to limit the number of other people that can do it as well. It's great for business, to have that sort of restriction in business is brilliant. And actually, I think the greatest value is in that long-term plan. Short-term, it's expensive to get in. The entry level is higher. That cost to get into the market is definitely a bit higher. But long-term really pays off. And having that sort of security, that confidence in the market, that sort of supply of tenants and that sort of restriction on the number of properties that can actually service those tenants, I think it is just such a good thing for businesses. But obviously, and you touched on this, the finance and the economics play a role here. And I said that the barrier to entry is often a little bit higher. It costs a little bit more to buy the same house next door that's got the compliance, hasn't it? It's part of a bigger picture. And you hinted at the commercial valuations. And obviously, the price that you pay is obviously a result of what you think it can be worth. Talk to us a little bit, Kieren, about how you get to that point. How do you actually figure out what it's really worth to you? And how do you navigate the planning challenges? Have you been buying things and converting and changing the use and going through planning? Have you been buying existing HMOs? Have you been doing a bit of both?
Yeah, to answer that in short is a mixture of the two. And I guess that's one of the advantages of, investing in Article 4 areas is that you don't have to take the full planning risk to convert from a C3 residential dwelling, which is effectively a family home, and take that full planning risk to go to C4 or sui generis use class. You can obviously buy existing HMOs, which is a little bit of a cheat code, if you like. You rightly, as you said, Andy, you'll pay a premium on that, a purchase price tax because it's already got that use and that consent. But that obviously de-risks the planning process for you, which obviously if, it's your first or, you're venturing into that investment space within Article 4 areas, does give you the peace of mind if you can, pay maybe an extra £20,000-30,000 subject to area. That would be relevant to the areas that I work within. It might be £5,000 or £10,000 further up north, for example, on the purchase price. But in terms of navigating that process, as I say, done quite a mixture. Portsmouth as an area predominantly converted majority of stock there straight from C3 to sui generis, a 7-bed and above use class. Other areas, the planning strategy is very much, focusing on buying existing stock because those local authorities are actually quite anti-HMO or at least anti-converting C3 dwellings to C4 or sui generis. So a bit of an angle on the market there is sort of acquiring rundown student properties, buying them at a time when, students are vacating at the end of an academic year, for example, sort of June, July time, typically entering the market at a point where you can get a purchase agreed, run through the conveyancing and try to complete on it, in time with those students moving out at the end of that academic year, picking that property up, then obviously running through your refurbishment schedule, converting, adding en suites, bathrooms, and then reletting that out, generally speaking, on a professional business model.
Just to comment, more of an observation than anything else, Kieren.
Yeah.
As you're speaking, it's very, very clear that you have a really in-depth understanding of your market on a very local level. And I often get a lot of questions. A lot of people asking me to look at deals. What do I think about this? And my response is almost always, look, I am not an expert in that location. There's a lot of stuff that's translatable, how you stack a deal, how you maybe plan a refurb, some of the planning challenges, but actually at the end of the day, you have to be that local expert. And I think there's just a few little nuggets there that you shared, which are great examples of how important it is to really know and to really be that expert in your local area. And I think for anybody listening that is looking at deals and doesn't have the confidence, is this the right price? Or am I going to have issues with planning? Or what's this going to be worth? Or what can I actually get out of this floor plan? That is, your experience telling you that you're not actually quite ready. You need to go and do a bit more work. You need to find out more. You need to go and find some support, some guidance, use the experts and the consultants, the planning consultants, the architects to help with this stuff. But it's really clear speaking to you that stuff is second nature to you. And actually, I can always hear the agent coming out in you because you've probably spent so much time appraising deals and so in tune with that local area. But I think it's a really important thing to pull out because a lot of people think that buying in Article 4 areas is this challenge that makes it impossible. You can't make the numbers stack. And I think actually, in a roundabout way, what you've actually done is really well demonstrate that actually sometimes it's just knowing where to push and pull, where the opportunities are, where the risks actually are, and how to actually execute on it. Let's talk about sourcing then. Another big challenge for a lot of people, particularly in Article 4 directions. It's not like, there's yellow pages of great deals to flick through or a catalogue. How do you source, Kieren? You've done a good number of projects over the last few years. How are you keeping that pipeline full?
Yeah, mixture of strategies. I will be the first to say that a good percentage of that stock has come from Rightmove. No qualms in saying that at all. I would argue that some people perhaps won't see what I see. And that, in a totally respectful sense, that's just because of the time that I've spent analysing houses and floor plans and knowing what works and what doesn't work. Yes, there's lots of stock that pops up, which, anybody can work out that house can be a HMO, but perhaps there's others that are slightly more intricate that, I've spotted something which I can, utilise permitted development rights, for example, in some way or another, prior approval extensions to gain that additional bedroom to make that deal work. Others have come through just relationship building with estate agents that, have bought a few houses through from before, and they generally like to sort of come back around when they've got another opportunity and say, hey, you bought the last one on X road, we've got right around the corner. Are you interested before it goes live? It's a win-win for them because they're almost selling it without needing to go to the market. They get a sale and their vendor's happy. Good business all round. Have also done direct to vendor work. Small percentage, probably 5% of deals has come through direct to vendor work. I know other people are huge advocates for it and only sort of focus on that. I guess the beauty of HMOs is that, the majority of them tend to go online. They doesn't generally tend to be very discreet. So a lot of the stock that we've bought has been marketed online, which I think is a good thing for people looking to get into the space. The deals are out there.
And I am not surprised in the slightest that you've said that because I have been saying this for years. Yes, there's direct to vendor. Yes, there's some slightly more creative ways of finding deals, but actually the foundation of any good strategy is just taking advantage of the online platforms. That is where by far and above most of the deals come from. And again, I think just knowing what to look for and then also maybe having that sort of backed up with a good rapport, relationship with agents, some buying experience. Again, you can hear that agent coming through and getting yourself to the front of the queue. Actually, it takes time to do that. It's very hard to do that on the first deal, isn't it? It's just, and also I think that it's really important for anyone listening that's just getting started to be conscious that sometimes if you go in too hot, you can burn a few bridges. And I think it's important to manage agent relationships delicately. Agents can be quite fickle. They happily sell to anybody at the end of the day. But if you give them confidence and they can give that confidence to their buyers, then actually you can put yourself in that kind of favorable position, almost at the top of that list. But I'm glad you shared that today, Kieren, because I think a lot of people, again, especially when you're talking about prime cities like Portsmouth, like Southampton, wherever it might be, think that the deals aren't there, that, the Article 4 direction, they just don't exist, but they are there. You just got to really know what you're looking for. You also talked about pipelining. Do you have any idea how many of your deals and offers were sort of rejected initially and then came back to you at some point down the line?
That is a good question. I've had a couple return recently that we offered on a little while ago. We weren't quite competitive enough. They've sort of gone into transactions that unfortunately have fallen apart for various reasons. So they do come back around. And I think a good point is always having however you choose to store your information and data, is having a log of everything that you've ever offered on or ever seen. Just because HMOs, I'm sure you'll have seen the same, Andy, but they are hard assets to sell. And there is every chance that if something does get agreed, that there's every chance that it will fall apart, not once, possibly twice, 3 times before it even sells. So there's definitely big wins in following up on stock. Even if it's looking like it's under offer online, there's every chance that there could be fractures in that deal, an opportunity for you to sort of sweep in and tidy up.
I think just to add to that as well, Kieren, a bit of advice that I give everybody is to say, look, at the end of the day, it's worth to you what it's worth to you. The asking price is the asking price. What you pay for it might be very different. It might be more, it might be less. It might be the asking price. But there's nothing wrong with putting an offer in at a level that you think works for you.
Yeah.
And sometimes someone will be prepared to pay more. Maybe they've got cheaper costs of borrowing. Maybe they're in a different financial position or have a different objective to you. That's fine. But a good portion do fall down. And actually, if you've got your hat in the ring, that offer is still there, you're in a great position if that does fall over for them to come back, have that conversation. You might want to up your offer. You might say, look, my offer still stands, but I'm not going to change it. And I've bought so many deals over the years, and some of those deals have come back 3-4 years down the line. Honestly, they've bumbled along. They've had a few sales fall over. They've decided not to sell it. Then they've thought about selling it again. They've picked up the phone. And I think that there's a huge value in just doing that. So don't, if anyone listening today, don't overlook just how valuable putting offers in, getting your hat in the ring, and just building a pipeline, following up 2, 3, 4 months down the line, just checking in. How's that sale going? Wish you the best. Look, if anything happens, just give me a call. I'd still be interested.
Yeah, no, I completely agree. And just to wrap up that point, just the relevance and importance of that, I actually saw someone post on social media some point last week. He just had an offer accepted on something. Originally, it was a huge commercial to residential development of sorts, but he'd originally offered on them and tried to negotiate it 2 years ago.
Mm.
And last week, it's gone through the cycles, it's come back around. And yeah, you think, what has that person done for a 2-year period in between appraising deals, volume of deals, completing on deals, and then something 2 years later has come back around, which they originally were interested in, which shows the power of the follow-up, as you say.
It happens all the time. I think a lot of people are not prepared to be patient enough when it comes to deal flow. Sometimes you just have to accept that a portion of your deals will come through pipelining and they'll come to fruition later in the year, in the following years. But if you give up too early, if you spend 3, 4, 5 months, get nothing accepted, and then walk away, then you've got absolutely no chance there. That you can guarantee what the result will ultimately be. It'll be zero. But if you can stick it out and be patient and just have belief and faith and just listen to what people like you and I are saying now, there is a huge, huge amount of value. Let's talk about commercial valuations then. We touched on it earlier. Obviously a key part of your strategy, Kieren. We've talked about this on the show a number of times. LER Broker has been on, and the way that lenders do it is sometimes different, but it's a very useful method, and especially in the prime space, isn't it, of engineering the right sort of value to make these deals work. But can you talk to us a little bit about your approach to this, how you actually try and engineer those commercial valuations and how it tends to work with the banks that you refinance with?
Yeah, absolutely. Again, similar to the Article 4 piece, commercial valuations are, again, all I've ever really known. So it's interesting because, again, not like a transition from a bricks and mortar HMO arrangement into commercial space. But yeah, for me, as you said, Andy, rightly so, commercial valuations ultimately allow you to sort of drive that end number, that GDV that you're working towards, and, arguably, like it or not, sort of, manipulate it to a position that sort of suits you, obviously within reason. There's a huge amount of work and due diligence and understanding of market data, rental data, yields, multipliers that goes into that to achieve that end number. But in a nutshell, all of that information, providing that you look in the right places, it is there through letting agents, through RICS valuation reports, if you're lucky enough to get your hands on some from other people, and that due diligence piece when you are appraising deals and appraising investment opportunities, you are in a position to within reason, sort of understand where that commercial valuation will take you to, and really work back from there. What your purchase price needs to be, what your build needs to be based on the number of units and the type of finish that you're looking to get to, and ultimately work back from the GDV to a point at which you deem that an acceptable deal from a 15% return, a 20% return sort of perspective, or whatever your investment sort of, profile looks like.
So what are you doing? You're taking an estimated gross rental income, are you? And then applying some operational costs?
Yeah,
and then
20%.
capitalizing that, whatever sort of the going rate is in Portsmouth, and that basically gives you there or thereabouts your commercial valuation.
Correct, exactly that. And obviously fortunate enough that, have done enough now that, have got a nice sort of case study of commercial valuation reports in the back pocket to sort of evidence where, we should be arriving at in terms of a finished GDV. But yes, if you're not fortunate enough to have those, your sort of, infrastructure for getting to that end goal, correct.
Do you recall how you felt the first time you were waiting on one of those commercial valuations versus perhaps how it is now with that experience and I suppose all of these other valuations in hand that you can just present or use as data?
Yeah, it's a good talking point, because obviously if you're buying in cash, for example, and you're carrying out a refurbishment with your own cash, you're probably not going to have, or you won't have, a valuation done on behalf of a lender, which great if you don't need any lending. Yes, your numbers might be significantly better off due to no borrowing costs. However, the advantage of buying with a bridge or using a refurb facility is that you have a valuation undertaken on behalf of the lender. And obviously off the back of that valuation, that valuer will give you an indicative GDV, based on local data, comps, rental rates in the area, which for me, especially if you're looking to get into, HMOs within Article 4 areas, or even not within Article 4 areas, having I call it a pre-built GDV, basically. Having that as a good indicator of where you're going to arrive, post completion of the development, is a good way for sort of sounding out your market before you sort of, get in too deep effectively.
I think that's a great piece of advice. Just helps just manage those anxieties about where you might end up. It helps manage risk at the end of the day. And I've even before advised people that have been buying cash, look, you're concerned about this because you just don't have the data. So the thing to do is just go and get a bit of data. You can actually instruct a valuation on your own behalf. Just send a valuer, tell them what the plan is, and go and get their opinion. They can do it on the desktop. They can do it, go and see the property, whatever it is. But I think that really helps narrow it down. And that's just, I think, one example of managing the risks in projects. You talked about build costs, and I want to come on to actually project management. But there's different things that we can do to actually try and mitigate the risks that come with building, and the risks that perhaps come with where we'll be at from an occupancy perspective. Location is a really critical part there. Let's talk then about build costs. You've obviously managed a lot of projects, Kieren. It's certainly, in my experience, is the more challenging aspect, I think, about what we do. And usually the bit that I find that there is the most variation. It's sort of where all the colour is between the lines. How do you keep on top of that? How do you manage projects, make sure that they come in on budget and you get the right spec and you end up with the right product?
Yeah, no, good point. So for me, we touched on briefly earlier, just before we got going, just in terms of sort of the tender package process. And I think in terms of running a successful project, so that, particularly that it's more on budget, we'll come on to sort of timescales after, is collating an extensive tender pack. As great as contractors are at what they do, they are great at building. They aren't, unfortunately, so great at other aspects. So my point being on that is that you need to show that builder every part of that process, from design to plans to structural to specifications, how you want the colour on the walls to be, from the carpets to the tiles. You need to show them absolutely everything. And that comes with collating an extensive pack, so that they're not stood there on site thinking, how do we do this or how do we do that? And then that's from top to bottom to top, in terms of all of the structural details, your wall types, your fire specifications, that I could go on. You need to tell them and make them aware of absolutely everything. So it's collating a full package to start with, to get to get off on the right foot of that project. And then it's quality control, it's site presence, it's being there, your health and safety, your site setup, from scaffolding to everything involved in that construction project from start to finish. It's site presence and the man management of that.
Builders, you made a good point. Your builders are good at building, hopefully. but
Hopefully.
their strengths are not necessarily elsewhere. Some of that can
Yeah.
actually be in costings.
Yeah.
One of the things that I have found quite consistently is that builders are not particularly good at project managing either. And I think that there is this misconception that getting a contractor on site and expecting them to project manage is part of the same job. And actually, managing a site is part of building, but actually managing a project,
Yeah.
procurement, cost management, the program, that is actually a different role. Now, builders can do it or have a go and do it to some extent, and I can't remember who it was, we had them on the podcast, but when you're paying a builder to do building work and then asking them to project manage, you're essentially giving them kind of carte blanche over the timeline, over the possibility or the ability to maybe charge extras.
Yep.
Really, that should be an independent piece of work. And if you're not able to do that, it might be worth bringing someone in, even just on a light touch basis, to do project management. I know for some people that can feel like an unnecessary cost, but it's very easy for build programs to run over by 20-30%, costing you a lot of money in interest, lost rent, lots of extras can be racked up. You can easily sort of accumulate quite a chunk on top of your original budget. So something to think about, but I thought it was a good point that you made. Let's talk about the programs as well then. How do you manage to stay on time and bring those programs in? And do you almost work to kind of a bit of a palette, Kieren? So have you almost systemized and, optimized this process so that it is a bit more predictable for you?
Yeah, it sounds like a fairly simple point, but a schedule of works in a detailed work that is your best friend for managing that time frame. Yes, you can ask the builders to produce one, or yes, you can give them one, but unless you're tracking week by week where they are in terms of, works complete and you valuing those works effectively against the overall schedule, you're very right in the sense that you can easily run over by 20-30%. And, candidly, at the earlier stages of my journey, I probably wasn't as sort of experienced and adept in that sort of area that I am now on the quality control measures that I've sort of brought in and that generally just through experience. But yeah, the types of contractors as well on these types of projects, they're not tier one contractors. They're not going to be used to working with QSs or, independent project managers. They are smaller outfits, respectfully less professional, but ultimately they're going to charge you less for that because they haven't got extensive overhead. So it is playing you as the investor or having that person, as a project manager is sort of a bit of a hybrid role at this sort of scale when you're doing smaller HMO projects. It is vital to delivering them on time. And obviously we haven't really touched on it yet, but another, sort of contractual point from setup with contractors, minor works JCTs. It doesn't protect you full circle. It's there to protect you and to protect the contractor, but it's certainly a starting point for putting in some infrastructure in place to hopefully trying to deliver it on time.
Absolutely. Couldn't agree more. And I actually think that a builder or contractor who didn't want to work under a JCT is a red flag. Why not? There will usually be because they want to find ways of stretching the program, stretching the budget. Maybe, they don't want the liabilities. The proper contract, like in Minor Works JCT, actually sort of outlines. I think especially, for anybody starting at the early stages, yes, there's a bit more work in getting a JCT set up. Yes, it can cost a bit of money. Yes, you might need a contract administrator to do it, or you're an architect, someone who knows what they're doing.
Yeah.
But the amount of risk that can offset is so significant. I think it's a complete no-brainer. And like I said, a bit of a red flag if a builder really didn't want to do it. But I'm glad that you've mentioned that, Kieren. And also the measured work. I'm just going to circle back around to that quickly, just for the benefit perhaps of some of our listeners that might not be aware of that. Guess what you're talking about, Kieren, is you're working with a bank or a lender. They're typically not sending you all of the money for all of the refurbishment all at once. They like to drip feed it to you. And often what they will do is they will want to send somebody out to review the works. Or even if you're just using a private lender, you may want to do this yourself or have someone do it. But when the builder is putting in an invoice for, let's say, £50,000 worth of work, have they actually done £50,000 worth of work? You talk about measuring the works. You're quite literally against, I imagine, the line items. How much of the plastering have they done? How much of the first fix electrics have they done? How much of the lighting is installed? You're actually measuring off what they've done. They put an invoice in. There might be a couple of things that need changing, and then you make a payment based on that. Another great way of just managing that risk so that you are always paying in arrears. Your builder is always working in advance so that if anything does go wrong, you haven't sort of financially kind of put your foot in it, so to speak.
Yeah, very poignant point in terms of making sure that, you're always effectively ahead because if you're not, that leaves you sort of open to exposure with a contractor, potentially walking off of a job, you're out of pocket essentially, and they're walking off with a bit in their pocket, plus maybe some materials. Whereas obviously, if, as you say, you always keep it in arrears, you protect yourself so that if anything does go wrong, you're not financially out of pocket.
Absolutely. And no matter how big or small that project is, that piece of advice, I think, is just as pertinent. This has been a really interesting episode, Kieren, because I think we've walked through the whole sort of process through acquisition, right through to refurbishment and refinancing. And I think there's a lot of value in here for our listeners. You've been doing this for a while now. And I know before we kicked off, you talked about the way that your business has been growing and how you're now transitioning to perhaps doing a little bit less client work and a bit more stuff for yourself. But with this experience behind you, I'm sure there's a lot of people listening today that would like to emulate some of your success and achieve some of the stuff that you have. What advice would you give for aspiring investors or even investors that have been doing it for a little while, but just kind of not finding a rhythm with it, just not being able to sort of create that scale that they want? What advice would you give them, Kieren, from all of these ups and downs of these projects that you've been doing?
Yeah, for me, I think a big part in sort of growing and scaling to where I have has been sort of personal brand. We touched on it earlier again in terms of when, first putting yourself out there, you you'll get rejection, you get pushback, people within your own sort of social group are like, what are they up to? What are they doing? But ultimately it doesn't matter to them. It matters to you. It matters to your future and potential business partners that you may find along the way. So getting yourself out there, building a brand, being sort of recognized for who you are and the value that you're able to provide to other people. And in terms of the product that you might create, be it student-led or professional-led or any other sort of model. And my second main point would just be action, take action. I've seen, unfortunately, so many people, talk about this and talk about that and go to this event and go to that event and do this training and do that training, and in 2 or 3 year time ahead in the journey, they're unfortunately still done, or, perhaps not got quite where they want to be. And candidly, again, it's probably through lack of actual action and just taking the steps that you need to progress. I know that comes with managing risk and potential risk, and perhaps taking wrong turns. But if you don't take action, then you certainly won't be sort of on that upward trajectory. So action is a big point for me. Yeah.
You know what? I think they are two brilliant pieces of advice. And I've seen that myself. I think a lot of people, that procrastination, that hesitation sometimes boils down to a combination of mismanaged expectations and just not actually understanding your market well enough to put the two together. And there is no deal, there's no scenario where the risk is absolute zero. There's always a risk. And I think the key thing is, what is the best case? What does the worst case look like? Realistically, where are you likely to end up? Have you done everything that you can to control the risks? At that point, that's where you've got to take action. There is no crystal ball. And I think that's where a lot of people struggle. And especially, I think, where people are trying to recycle all or a lot of their capital out because they're so focused on the next deal, they don't even do the first deal. So for anyone listening today, heed Kieren's advice today. I think it's really good advice, but don't be that person that hesitates and procrastinates because you are so worried that, the deal is not going to be perfect and it's not going to line you up exactly as you want for the next deal. Sometimes you do have to stick your neck out, but property, certainly in the UK, it is quite a forgiving asset class. Try not to put too much pressure on yourself to do everything all at once. Sometimes it does just take a little bit longer, and sometimes the route to get there is not completely straight. It's not a completely clear path, is it? But Kieren, it's been a real pleasure to have you on the show today. A really interesting conversation. For anyone listening that wants to find out a little bit more about what you do, maybe is interested in investing with you, or maybe how you might be able to perhaps help them invest, how best can they get in touch?
Yeah, so I'm on various sort of social media channels, as we mentioned and touched on earlier. I'm not doing really any sort of client-facing work, but, I have got sort of mentees that I've coached previously and in the process of coaching as well, if that's something that you'd be more so interested in. But yeah, I've shared a lot of sort of value and information on my social media channels, being Facebook, Instagram, and a little bit on the YouTube channel as well. So if you're looking for some more sort of content around those aspects, then that's where you can find me.
Brilliant. Go and give Kieren a follow. Kieren, thank you once again. It's been an absolute pleasure, a really interesting conversation, and it's been great to have you on.
Really enjoyed it, Andy. Thank you for having me.